Hello, I'm Brian Kozlowski, and this is the Investment Management Lab. And this is where I like to think about the things that we as investors do that ultimately detract from our performance and how we can use that information to create roadmaps for better and better outcomes for ourselves and for our clients. Now, today I did something a little bit different. Sat down with Professor Daniel Taylor. He is the Arthur Anderson Associate Professor at the Wharton School. He's an expert on insider trading. We talked about 10b5-1 plans, about unethical trading behavior of insiders, the work he's doing to help bring this to investors' attention and ultimately help combat this and create an environment where ethical trading behavior is the norm. I really think you're going to enjoy this conversation. He is a wealth of information on this topic. Throughout this interview, I'm going to use a number of terms, and I suspect you will too. To avoid confusion, will you describe the following terms for our listeners? What is material non-public information?
So material non-public information is information that isn't public, that someone knows about, that if revealed would materially alter a reasonable person's judgment about the value of the company. So a standard test in law and economics for material non-public information is when the information, which is non-public, is finally made public through a disclosure, what happens to stock prices and to volume. And if the stock prices change by a large amount or the volume changes by a large amount, and by large, we're talking maybe like 1%, then we would say that that's material to firm value. Because if you have like $1 billion company and the price change is 1%, that's actually a pretty big dollar value, right? Like $10 million. So that would be an example of material non-public information. Where there is disagreement is really between how the law is being practiced and the economics behind, how we define material non-public information. So let's go through some examples to understand some of the subtleties. And none of these theories, I would say, have been tested yet that I'm aware of in the court system.
Okay.
So let's say you're a high-flying CEO. You've got the tech company, it's your baby, you're the founder, you're kind of like Elon Musk, right? If you retire or something happens to you, the value of the company will decline because you're like a key personnel in the company. And suppose that that you have some sort of medical ailment, cancer per se, almost like a Steve Jobs situation. Right. And you know that, and you begin to trade, to start liquidating your shares in the company. Are you trading on material non-public information? Now, an economist would say yes, because once it's revealed that you have cancer, the stock price may react.
Right.
So imagine Elon Musk coming out and saying, I have terminal cancer. Right. Stock price is going to plummet. If he traded while in possession of that information, you could make a legal case that he may have engaged in insider trading because he traded while in possession of information that would move stock prices when it was publicly revealed. You can do something similar with retirements. If the CEO knows that if they're a key CEO and they know they're going to retire, they haven't announced it, and they liquidate shares, or maybe their spouse liquidates shares. You'd be in a similar situation where you have information that's material, meaning it would move stock prices.
Right.
And so I think there's been a lot of talk about materiality. That's where things I think are really interesting. There's been a lot of people saying, "Oh, materiality is great. We should stay with materiality." For disclosure rules, around ESG, around everything generally. But I think there's a lot of disagreement about what's material.
Sure.
And I think there's a clear economic definition. Would it move stock prices? But that hasn't been embedded in let's call it the legal cases.
Insider trading. What are we talking about there?
So people use the word insider trading. You need to look at the context for insider trading. So in the academic literature, when the term insider trading gets used, it means the trading of corporate insiders. So it doesn't denote legality. It says who's doing the trading. Well, the insiders are the ones doing the trading. So the officers, the directors, those
C-suite level people.
Right. C-suite level, section 16. There's a specific term, section 16, corporate insiders. So technically you've got corporate insider trading. Then there's the legal connotation, where we get into what constitutes insider trading under the law. And, insider trading in the US is typically viewed as illicit and illegal. But, trivia for your viewers, there is no law in the US against insider trading. There's no law that says thou shalt not insider trade. What there are a series of case laws that have been used or construed to prosecute insider trading, typically like a breach of a fiduciary duty or a breach of confidence,
Okay.
or some sort of like anti-fraud or mail fraud type statute.
Okay. How about like a blackout period? What are we talking about there?
Blackout period. So blackout period is typically in the context of a corporation or a company. They'll have a corporate event like an earnings announcement, and the blackout period will be a window around that event where trading by officers and directors is prohibited by the company.
Okay.
So a traditional blackout window for a corporation might range from, say, the quarter end, right? So quarter ends March 30th, and the blackout window will extend until maybe a day after the earnings announcement.
Okay.
So maybe they announce earnings May 1st. Blackout window means no trading between the quarter end and, in that case, May 2nd. And the reason for that is because between the quarter end and the earnings announcement, we typically think that the officers and directors know what the quarterly performance was.
Sure.
And so if they traded in that window, they're in danger of being prosecuted for trading on material non-public information. And so the company has those windows to minimize litigation risk.
Okay. And then, so on the same kind of note, how about a cooling off period?
So we've got these Rule 10b5-1 plans. Okay. So they're going to be adopted on a certain date. Let's say that I adopt a 10b5-1 plan today. A cooling off period would say that the plan cannot execute a trade until a certain number of days after the plan was signed and adopted.
Okay.
So, for example, if I adopt today and there's a 30-day cooling off period, then my first trade under the plan can't occur until at least 30 days later.
All I want is a yes or no answer, like nothing but that. The question is there, a mandate, like an SEC or government or a mandate for them to have a blackout period associated with these events? Is there a mandatory blackout period associated with earnings announcements?
No.
All right. How about board meetings?
No.
How about investor conferences?
No.
How about releases of financial disclosure statements such as 10K, 10Q, or 8K forms?
No.
How about SEC investigations, litigation, government investigations?
No.
How about announcements about things like mergers and acquisitions?
No.
How about like a new product or discovery that they're going to talk about?
Like a vaccine, something like that.
Something
right?
like that, yes.
Yeah. No.
Okay. How about changes in control of management, say like retirement or firings or layoffs, things of that nature?
No.
If a company is going to announce that they're going to a repurchase plan, would they have to put by mandate of SEC, put a blackout period around that announcement?
No.
There's material non-public information associated with all of those events.
Yes.
And yet there's no mandatory blackout periods associated with any of these events. I mean, I'm sensing a pattern. I think I could go down and go through 10 more things, and the answer is
I am not aware of any event other than perhaps an IPO where there is a mandatory blackout period that's required by the SEC. Now, even in the IPO example, it's not required by the SEC. It's as a condition of potentially getting funds from the underwriter and the insiders not selling. However, what we see with SPACs is that blackout period, there is a blackout period, but there is language that allows the blackout period to be waived. So blackout periods not required.
Right.
What is required is that, and this is a listing standard, NYSE and NASDAQ require that the listed companies, and I believe Amex too, adopt an insider trading policy that is enforced by the company for their corporate insiders. They do not specify what details that insider trading policy must contain. I have personally I know of anecdotes off the top of my head of companies listed on NASDAQ that do not have blackout windows around their earnings announcements. And I find that concerning. But if the company doesn't want to put a blackout window, I guess someone could make the statement, then their executives are going to be subject to risk from being sued for material non-public information.
Right.
So presumably there's a trade-off there. Do I think it's a problem? Yes.
The SEC introduced Rule 10b5-1 as a mechanism for insiders to trade their company shares. Can you better describe this rule and tell me what the intentions of the SEC were?
We just had Sarbanes-Oxley and a bunch of accounting scandals, Enron, being, the one that everybody tends to remember. So the concern is that we've got this Sarbanes-Oxley rule. It's changed how we report our insider trades. So we used to not have to report electronically. You have to file electronically. We're going to make it mandatory, everybody electronically. We're also going to switch the deadline. So now you can't take months to file this thing. Now you have to file it within 2 business days.
Right.
In addition, what we're going to do is we're going to create this thing called a Rule 10b5-1 plan. Because, rightfully so, executives get a lot of their compensation in equity, in stock, in options. And they need to convert those to liquidity so that they can, buy the yacht, send the kids to college, consume, or diversify. Maybe they don't want 80% of their net worth concentrated in the firm. Maybe they want to diversify some into the S&P, buy some real estate, buy some Bitcoin, whatever it is. So they need a way to be able to sell large quantities of shares and large dollar values without arising suspicion. Okay, so you see a CEO sell $100 million, worth of stock. Everybody's going to be looking twice at that transaction. So Rule 10b5-1 was supposed to give the executive a way to engage in such a sale, to get that liquidity or that consumption without arising suspicion. And the way that they would do that was to enter a plan or an agreement, non-binding now, a plan or agreement, where they would write down how much they wanted to sell, like number of shares or whatnot, and then the prices or the dates on which they wanted to sell. They'd sign it, and then they'd just step away. So it's kind of like a blind trust for a series of trades, not for managing your wealth, but just for managing, let's say, selling a certain dollar amount of equity. And then the plan automatically executes without any intervention from the executive. Now, as I have described it, that seems pretty reasonable, at least if you were to ask me. It's like, okay, you say, I need to sell $100 million. I don't have any material non-public information now. I'm trusting you to just sell $100 million. We're going to dollar cost average or something over the next 6 months. Just convert my equity into cash. Right. And then I'm just going to walk away and run the company. And I might come into material non-public information while I'm running the company, but you can't use that to go, you can't use those trades against me because I pre-committed to those trades.
Right.
When I signed, the contract. So that was the spirit of what Rule 10b5-1 was supposed to be doing.
Okay. Describe a timeline associated with one of these plans. Albert Bourla, the CEO of Pfizer, on August 19th of 2020, he implemented his 10b5-1 plan. Okay. August 20th, the day after, Pfizer says, hey, we've got this vaccine. It works.
Yes.
Right. Maybe that's a coincidence. I have no access to what was going on in that company, but then I see November 9th, they come out with another announcement saying, hey, not only do we have this vaccine, but it's more than 90% effective, which just happens to be the same exact date that his 10b5-1 plan triggers a sell. And not just a small sell. This guy sells 60% of his holdings in the company to the tune of $5.6 million. It is entirely possible that that was complete coincidence, but it seems to me very suspicious on the surface.
Yes. And so I started, before I did my research, I started at the same place that you were at. Exact same place. Like, what the heck is going on? It's not getting charged by the SEC, the DOJ. Like, why not? So it's the difference between the letter of the law and how the law is actually being executed by the courts. The existing case law is you can't trade on material non-public information. Did he trade on material non-public information? This might get me in trouble, but an economist would say absolutely. Because if he knew about the press release when he adopted his plan, which, the press release you said was 1 day later.
Yep.
Right. It's conceivable the CEO knew about the press release. And
you'd be hard pressed to imagine a situation where he wasn't knowledgeable of that.
And the press release definitely moved prices.
Yep.
Right. So we can't argue the press release isn't material. So the press release is certainly material, and he certainly knew about it. So logically, you would then say, as an economist or a student of the markets, okay, he's traded on material non-public information. You saw the same things at Moderna.
Yep.
Right. In fact, I'm on record in an NPR article saying, Moderna is really, really concerning. So why hasn't anything happened, and why won't anything happen? Because a nuance. The law is not really, thou shalt not trade on material non-public information. It's more like, thou shalt not benefit from trading on material non-public information.
So in this case, I would say he benefited, but.
Well, okay, so let's walk through this. So stock prices are going up, right? So the vaccine is being successful. They put out, the 90%, success rate for the vaccine.
Right.
Stock price goes up.
I mean, that particular day it popped by like 5%. Well, I can't remember the exact percent, but there, you look at the chart, there's a giant pop there.
Many 10b5-1 plans have, and I assume your listeners will know what a limit order is. Many 10b5-1 plans are limit orders, where once the stock price hits a certain price, it triggers an automatic sell.
Yep.
So I have not seen Burla's plan, so I don't know, but I feel fairly safe at speculating that he had a limit order in there at a certain price level, and it hit that price trigger. And I don't know for sure, but that's what I would speculate.
If he didn't, it would be even more concerning.
Okay. So now, did he benefit from trading on material non-public information? He didn't avoid. How do we typically think of this when we have a sell? We typically say, well, benefit means sell before a stock price decline.
Okay.
So he didn't, in this case, he didn't sell before a stock price decline. Right. Yeah. So it's not like what is his dollar benefit from selling at that point? Like suppose that he knew that it was going to be 90% effective. Well, I mean, there's no way that he would know, but like, how would the strategy be different? Where things would be different is if the vaccine failed. If the vaccine failed, right, and the trade kicked off before that, that became public, well, at that point you say, okay, you sold, and consequently you avoided a loss. So to get an insider trading conviction, you need to prove something known as scienter, which is, a mindset or an intent to deceive. And so in those pharma cases, it's really hard to get to that point of intent to deceive, because especially in some of these cases, the stock price just kept going up and up and up and up and up and up. Now, that doesn't mean that it's not there, but it's harder to do that than in other cases where the sale precipitates a stock price decline, or precipitates bad news. So the way many of the class actions work is you'll have a sale that precipitates bad news.
Let's ignore this particular instance, but if I say, hey, I'm gonna set up this plan, I'm gonna sell 50% of my holdings on this particular target date, and I know I have an announcement coming up. Let's say it's a vaccine, but whatever, some biotech company has this thing that it's either gonna be a flop or it's gonna be a huge success. So I could say I'm gonna time the announcement based on whether it's positive or negative. If it's negative, I'm gonna make the announcement after my sell is triggered on that date. Right. And if it's positive, I'm gonna announce it before that date is that date happens and triggers my. So that's this, so again, I have no inside knowledge here. It could be all on the up and up. But this raises an interesting question. Many analyses take the disclosure as fixed, and they look at the timing
of when the trades occurred, before or after.
Yeah.
They don't do what you just did. And this is what some of the academic literature does, is it says, well, not only do executives have discretion over their trades, but they have discretion over the timing of the disclosure.
Right. Of course.
So I could sign a trade, that might execute on like June 15th. And I've got some news that's coming down the pipeline.
Exactly.
And I know I've got $100 million trade executing June 15th. And if it's bad news, we'll disclose it June 16th.
Yes, exactly.
And if it's good news, we'll disclose it, June 13th.
Exactly.
But wait a minute. I entered the plan, my June sale. I entered that plan back in January when I didn't know about the news.
Yep.
You could argue that the executive failed in their fiduciary duty, I suppose, by altering the timing of disclosure as to when would maximize their own benefit.
Right.
That's potentially distinct from saying you knew what the news was when you traded.
Yep. Yeah, it's like two sides of the same coin, essentially, right?
Correct. Exactly.
In some of your work, you've listed off, a number of things that you see as just problems associated with these 10b5-1 plans.
Yeah, I mean, you have to. What's cool about this is, and you always have to dig below the surface, right? Because I started out by saying, the executives need to be able to sell millions of dollars in stock just to,
There's lots of legitimate reasons to do that.
Absolutely. And they need to be able to do that without a rising suspicion of insider trading. So they're going to sign, remember, they're going to sign this contract to sell, 10 million shares, and then they're just going to walk away and the contract's going to execute on its own.
Yep.
So first, let's talk about where things come out. That contract does not have to be disclosed to shareholders, to anyone. Doesn't even have to be disclosed to the SEC unless they're under subpoena.
Yep.
The existence of the plan doesn't have to be disclosed. So the company doesn't even have to say, Brian's entered a 10b5-1 plan. Don't even have to say that. And so they don't even have to tell you the amount. So this is a particularly egregious example is Les Moonves of CBS, poster child for the Me Too movement. He had effectively a single 10b5-1 plan that liquidated over $150 million of his wealth. Now, if you were a governance professional and you were thinking, how should I vote on his compensation for the next year? Do you think you might want to know whether the CEO has planned to liquidate $150 million in shares?
Right.
Probably, because if he's planning to cash out, why would you want to give him even more? Yeah. So that's they don't have to be disclosed. Probably should be.
Yep.
All right. So that's the first thing.
Yep.
The second thing is when the trade executes, as we talked about with Form 4, that has to be filed within 2 business days with the SEC. Okay, the trade has to be.
Yep.
On that Form 4. The filer does not have to disclose whether that was a 10b5-1 trade or not.
Okay.
So, for example, in a lot of the pharma cases, Moderna, Pfizer, Novavax, and some of the others, they took a step in voluntarily disclosing that the trades that their executives were executing were 10b5-1 trades, and they even disclosed the date that the plan was adopted.
Yep.
They didn't have to do that.
Okay.
All right. So that's the first thing. Disclosure of the plans. Don't have to disclose the plan. Don't even have to tell us whether the trade happened.
Yep.
Right. That's where first thing goes wrong. Right. Very simple. Right. Sunshine. I'm a big believer. Sunshine is the best disinfectant.
Yep.
All right. Very famous thing. Very, very much applies here. So then it's all right. So that's the disclosure. What about the actual execution of the plan? Well, here's where things start to fall apart. It's very much the case of the best laid plans, forgive the pun, of mice and men. What if the plan isn't binding? What if the executive can cancel the plan at any time? So we put the plan in place. We say, sell 1 million shares June 15th. Okay.
Yep.
I learn over the course of my duties. I put the plan in place in January, and it's now I'm going to sell on June 15th, and it's now June 1st. And I learned, we're going to announce a mega merger on June 30th that's going to send prices soaring. I don't want to sell on June 15th anymore. Prices are going to be higher on June 30th.
Right.
I can cancel my plan, and I can cancel the specific trade. And that's legal.
Okay.
So I will emphasize that it is under current SEC guidance. At least I think that it's been shown in court. There are obviously certain contexts and nuances to it. It's potentially legal to not trade on material non-public information. And the act of canceling a trade is considered not trading.
Yeah.
So there you are using material non-public information to benefit yourself.
Yep.
But it's not through trading. It's through the absence of trading.
Right.
Right. So that's an issue.
Okay.
It's kind of like, wow, I never thought about that. Right. And it's clear that when they proposed the plan, they didn't think about that. Right. And again, that's that non-binding aspect of the plan.
Right. Okay.
Right. Second thing of the plan, there's no rules or regulations on when you put the plan in place and when the first trade can execute.
Yep.
So we talked earlier about blackout windows.
Yep.
Some companies allow 10b5-1 plans to be adopted inside a blackout window. Some companies allow 10b5-1 plans to be adopted in a given quarter and then to execute a trade in that same quarter. So this is in some of our academic studies, we call this a red flag for abuse.
Yeah.
So example is you adopt a 10b5-1 plan after the quarter end, but before the earnings announcement.
Okay.
The plan executes a trade before the earnings announcement.
Right.
So adopt the plan, 15 days later, the plan pops off its first trade. In what sense is that helping, eliminate the possibility that you traded on material non-public information?
Yeah.
Because the time period between when you adopted and when you traded is so small. At that point, why wouldn't you just place either a standard limit order or a regular market order?
Right.
Our purpose of the 10b5-1 plan, as intended, was to liquidate large portions of shares, over regularly spaced intervals over time, almost like a dollar cost averaging. Like diversify the sell, spread it out. But that's not what's required by law.
Some of these plans are adopted, and the first trade happens like the day after.
Where we have some where they occur on the same day.
Right. Right.
And so the only purpose of those plans is
just
to
like pretend, safeguard, and
yes, it's to provide a veneer of legitimacy.
Yep.
But it's effectively no different than a market order or a limit order.
Right.
But the law, or the rule doesn't specify a timing gap between when you can adopt the plan and when it can first execute a trade.
This cooling off period you talked about originally.
Right, and that's the cooling off period. So, what Chairman Clayton recommended was a 4 to 6 month cooling off period. In my op-ed with Commissioner Crenshaw, we're also in that same 4 to 6 month cooling off period recommendation. And that's not a, hey, let's just, everybody pull together, where did we come up with 4 to 6 months? The data support that once you hit the 4 months, you can't adopt the plan and trade in the same quarter, because the quarter is only 3 months.
Right.
So that 4 month cooling off period forces there to be more than a quarter difference between when the plan is put in place and when it executes a trade, which eliminates this notion of, adopting a 0-day plan that executes a trade, 15 days before the earnings announcement.
Right.
And so in the studies, that's what we would say evidence-based policymaking. The 4 months in the data, we calculate loss avoidance, and there doesn't seem to be any loss avoidance for those plans that waited 4 months.
Okay.
But there's plenty of loss avoidance for plans that didn't wait 30 days.
These plans were supposed to be put in place to kind of define a pattern of trades, or a plan to sell. But some of these plans have one and only one trade involved in them, so they really don't seem to be meeting the spirit of the original intention.
That's right. And so, like, when you look at that, remember again, that spirit of that original intention of having that contract that slowly sells off chunks of that, let's say that 100 million block that the CEO wants to sell.
Yep.
It's repeat transactions spread out over time.
Right.
And in practice, the single trade plans are very, very common.
Okay.
I mean, it's just a single trade, done. So, and I should caveat, when we say single trade, we mean single trading day. So
fair enough.
Dump 100 million in a single day. It may occur across multiple trades, but it's done in one day.
Yeah.
And so that's another red flag. What we find is that plans that implement only a single trade, they tend to avoid greater losses than the plans that implement multiple trades spread out over time. Right? Because if you think about it, if you're actually trying to time the market, right? So suppose that put your mind in the head of somebody who wants to engage in insider trading, right? It's much easier for them to time a single event,
of course,
than it is to say, well, okay, I have to sell a block every month for the next 6 months. How am I going to game that? That's much harder to game.
Right. Because they're putting these plans in place. It's supposed to kind of give them a safeguard, but we're finding that experts are basically saying, well, they're not really looking at what's happening. They're saying, well, this is common practice, therefore it must be okay.
I just think it's endemic to the system. And so you think about how things are set up, there'll be a company, the company will hire a legal counsel, that legal counsel will have a certain way of doing it. All of their clients, because they're clients of that legal counsel, they all do it that way.
Yep.
Right? At the enforcement agencies, you might begin at the enforcement agency as a young trial attorney, really wants to, get your teeth cut and help out and be really super ambitious. And then over time, things sort of like you realize how things are done. And then you get stuck into, well, this is how it's done. Right. So you have this is how it's done both at the law firms, and you also have that at the enforcement agencies. Part of the issue is that we've had remarkable changes in technology. I don't think anyone would dispute that. Remarkable changes in technology.
Right.
And those changes in technology have not fed in. I mean, they have to some extent, but have not fed in completely into both counsel's decisions in terms of how to structure these insider trading policies and the enforcement decisions in terms of how to detect and potentially prosecute.
You and some of your colleagues you're calling for some very specific changes. Can you walk me through, what you're proposing?
The first set of changes is to the disclosure for these plans, and the second set of changes is to the actual rule and how the plan would operate. So like structural changes. Let's talk about disclosure first.
Okay.
First, big change. We think that Form 4s, the trades of the officers and directors, should be required to be filed by all companies listed on US exchanges, regardless of whether your headquarters is in China or in Wilmington, Delaware.
Okay.
Seems pretty straightforward.
Yep.
Okay, that's the first one. All right. So second, on the Form 4, we want to add a little spot that the filer would indicate it's a trade due to a 10b5-1 plan. Here's the date that the plan was adopted and modified. Okay.
Yep.
So the Pfizer and Moderna, some of the pharma trades that voluntarily disclose that information would be made mandatory disclosure. Yep. As opposed to voluntary. All right. So now we're getting warmed up. Second, remember we talked about how the plan could be canceled or modified while they were in possession of material non-public information. That wouldn't necessarily run afoul of securities laws. Right. So what we are calling for is to make an 8K filing. 8K filing is for material corporate events and material contracts. File an 8K whenever a plan is adopted, modified, or canceled.
Okay.
Okay. Now the first thought is, well, that seems really burdensome. And well, it's only burdensome if you cancel and modify the plan a lot.
Right.
Right. Yep. If you use the plan as intended, it won't be canceled and it won't be modified. And so all you have to do is file the initial disclosure. So this is what the burden of disclosure is supposed to do. The more likely you are to be gaming or abusing the system, the greater the burden of disclosure is for you. And lastly, we want to see the entire plan filed with the SEC on an 8K. And there are current 8K rules under the FAST Act that would allow the filer to redact portions of that plan. So if they don't want to reveal, their address, their brokerage information, if they don't want to reveal the prices, so like we talked about, like limit orders, they might have like sell $1 million at this, 2 million at that, 3 million. If they don't want to reveal either the shares or the prices, they can redact that information.
Okay.
But the point is that the SEC will have the unredacted version.
Okay.
So it would be very easy in the pharma case to say, hey, look at this like really, really shady thing or really suspicious thing. The SEC can immediately pull up the plan. No, it looks bad, but it's kosher. We got the plan right here.
Right.
There are some brokers where I would question whether there is even a written plan. I will not name the brokers or the companies, but I have some anecdotal evidence that not all of these plans are as written
Okay.
as you might think. So that's really what we're looking for. File it with the SEC. Everything's above board, right? And again, you can redact it, if you want. So those are the changes to disclosure. Sunshine is the best disinfectant.
Yep.
Okay. And then the change to the rule itself is we're calling for a 4-month cooling off period. So basically, from the day you adopt the plan until when that first trade executes, you have to wait 4 months. And the reason is that will push the first trade that you can execute into a different quarter.
Okay.
Meaning you couldn't adopt and execute the trade before that quarter's earnings announcement. So that is still gameable in the sense that you could have long-term material non-public information that that you're going to announce a new product, 8 months from now.
Right.
Or there's some disaster coming 10 or 12 months from now. The cooling off period of 4 months isn't going to stop that. That's really hard. A, to prosecute. I'm not aware actually of very many where there was that long horizon.
Okay.
And B, it's very rare because if you asked executives, what the earnings are going to be 12 months from now, I think, they would pay lots of money to know what the earnings were going to be 12 months from now.
Right. Yeah.
So really, it's those short-term trade. It's those short-term plans with low cooling off periods where there's no disclosure and they're execute a single trade, right? Like adopt the plan, dump $1 million 5 days from now.
Yeah.
Done. Right. Those are the ones that are the most opportunistic and that we don't think are the most, we think are the most inconsistent with the spirit of the rule.
Now, are you calling for the elimination of, single trade plans too, or are you calling for any kind of,
So there's a trade-off. So I think that you can bundle, so this is, an academic point, you can bundle disclosure with changes to the rule. So for example, if someone says, oh, well, we really don't want to disclose the plan to the SEC, then I would say, then you shouldn't be having, multiple, you shouldn't be having a single trade plan. The advantage of disclosing the plan to the SEC is that it sort of neutralizes that single trade being opportunistic.
Okay.
Because the SEC can see up front, it was a single trade plan, but it appears perfectly legitimate, as opposed to a multi-trade plan where they all got canceled and it was rendered effectively a single trade plan.
Okay.
Right? That's what you're really worried about. You sign up with a plan where you would say, okay, I want you to sell $10 million before every earnings announcement. I don't have any non-public information. Okay, first one executes, no problem. Second one, you're going to sell, it's bad news. You're going to have bad news for next 2 quarters. First one executes, avoid the bad news. Second one executes, avoid the bad news. The quarters 3 and 4 are going to be good. So now you don't want to sell anymore. So you cancel the plan.
Yeah.
Right. So that's what we will avoid by requiring the plan being disclosed to the SEC.
I would argue that the average person, the average investor, believes that insiders have a relatively easy time engaging in unethical trading behavior. Now, the SEC has some tools, Atlas, Artemis. You and your colleagues are developing the Forensics Analytics Lab. Can you describe these tools and help us understand the headwinds inherent in enforcement of trading behavior of insiders?
For better or worse, the academic evidence suggests that the SEC is primarily a reactive agency, not a proactive agency.
Okay.
So what that means is that when Wall Street Journal or Washington Post breaks something, then the SEC will be all over it. The GameStop, for example. Or when the whistleblower blows the whistle, then they'll follow it. Right. Or when the short seller puts out a short report, then they'll follow it. As opposed to a proactive approach, which is actually trying to get ahead of that curve. Now, that's very difficult to do because, I've worked with people at the agency. I enjoy doing so. I think that, I do not believe that they are as politically captured as many people might suggest.
Okay.
I think the primary constraint is the bureaucracy. So you have an agency that's got the budget set by Congress, right?
Yeah.
Think about what's going on in the market right now. All kinds of weird stuff. So if the agency wanted to if the enforcement arm of the SEC, just to keep track of all of the weird stuff going on in the market, the $100 million deli, GameStop, all of this stuff,
right?
They should have more than doubled in size for the workload, but they're not.
Right.
And they're also on, a rather archaic government pay scale, right? I mean, a lot of these people can get paid more in private sector than they can at the SEC. That's not a good thing. We want our best and brightest on, trying to detect and prosecute crime, not trying to defend crime, right? And so we've got an under-resourced agency that's also understaffed and underpaid. And so that leads to this crisis of under-enforcement, where you've got a lot of things going on in the market and the SEC is just trying to, keep their head above market, keep up with everything.
Right.
Lately, they put out reports saying, we're not even going to look at the SPAC registration statement unless it's audited. It's very reactive to GameStop, reactive to sort of like the 10b5-1 issues. And so
they can't even really keep up, and when they do that, it's the big high profile ones that they're able to even do.
Correct. And there haven't been that many, some would point out there haven't been that many big high profile ones. And that's one interesting question. Why haven't there been? That's another podcast or video.
Yeah.
But so that sort of set the stage for where myself and where my colleagues were thinking. It's like, okay, we're academics, right? We're not lawyers. We think this is a problem. What can we do? Right? And like you go through the list and there's not really that much that we can do. Like we're not in the trenches, right? But what we can do is we can educate. We can educate the next generation about the circumstance, about how to better detect fraud, about how these schemes are carried out, about the challenges that they're going to face, about technology, right? We can educate people in the media, educate people, individuals such as yourself, your viewers, right? So that's really the role of an academic is educate, not just students, but society in general, so that everyone's aware of these issues plaguing our enforcement agencies. And maybe, hopefully, our preferences will be expressed through our elected representatives, and maybe the agency will, get some more money and tool up, and things will change.
Right.
But that's kind of where we're at, and that's where the lab was created, was this desire to educate, not just students. I teach a class on forensic analytics, but we've done a lot of work with members of the press, helping them, educating them about certain challenges around certain issues.
Okay.
Doing certain data analysis. A lot of these cool charts that you might see. We've in some forensic analytics type articles in the popular press we've helped with.
Okay.
And then now we're starting to move into tools. So beyond education, is there something that we can do? What's our comparative advantage beyond education? Well, one of our comparative advantages is that we're really close to the data, right?
Okay.
Really close to the data means we have this blend of reasonably good institutional knowledge of the legal system, reasonably good, not experts, reasonably good, detailed knowledge of accounting and disclosure, and we also have a reasonably good knowledge of coding and how to do data analysis.
Okay.
So that's where the magic happens, where you put together people that are experts in law with people that are experts in data science, and you have one person in the middle who can talk to both of those experts, who can't communicate to each other.
Okay.
Good luck getting a computer scientist to talk to a lawyer about how to establish or defend from a scienter claim or securities suit. Right. So that's really what the lab is about, is to helping people collaborate, towards detecting and disciplining, misconduct.
Okay.
In capital markets. I should say, I got to get this in. If you like the work we're doing and you're listening to the video, Wharton Forensic Analytics Lab, we're looking for industry partners. We're going to start a case series soon. sort of postmortems on fraud, on government investigations, SEC investigations, both from the regulator's perspective and from the defense side. So how to navigate one of those investigations if you're ever in it. You know, how could Wirecard or Luckin have been detected? What were the warning signs? And I will say, I'm not a good salesperson, but you know, labs don't fund themselves. So if you find yourself in an interest in this area, and you know, we are making a difference with education and media outreach, and if you're interested in funding, you know, shoot me an email. You know, we'd love to talk to you.
It's just very, very interesting stuff, and again, I just applaud what you're doing here. I think it's fantastic.
I appreciate it.